Hello friends, welcome to Nirmal Bang. I'm Piyush Jain and today we are going to be focusing on a commodity discussion here. Of late, we have seen in the markets crude prices have been on the boil. We have done a conversation on this show earlier. You would have watched it, I'm very sure. Crude prices, Brent in particular, again hitting $90. Perhaps OPEC meeting is next month. We could be actually again sort of expecting more sort of rise. There is also some weather elements coming from US where the hurricanes are supporting the crude price rise. But what is happening in the market, we'll try and find out about that. But apart from that, across the board, whether it is gas prices, WTI prices, we are seeing diesel prices, we are seeing an uptick in the entire energy basket. So the question before now for us, even if you're assessing the listed universe, is that what is going to happen on the energy prices? It has a direct cascading impact on the inflation, also in terms of margins for a lot of companies. So this discussion becomes very important from a global perspective. Let me now welcome our guest of the show today, Mr. David Lennie, the resource analyst of Fat Profits. Mr. David, welcome to the show.
Hi.
Now, it has been a long time. We have done many discussions like this. So let's start with the crude. According to you, what is happening in the crude prices? Some time back, we were seeing it trade around $70. And now gradually it has inched, climbed up, now starting to hit $90. Where it can go and what's the underlying reason for this bullishness?
Oh, look, there's no doubt about it. If you're having a look at what's happening in the crude market, it's all up to what OPEC are doing. And on that front, we've seen Saudi Arabia and Russia both extending the cuts. So we talk about them as cuts, but they are now normal production numbers. The extending the cuts that they have had in place now for some months, and those cuts are going to be extended out to December. What that means is that the market thought we were going to see the cuts only perhaps move to the end of next month, but they've added 2 extra months, and that's really caught the market somewhat by surprise. And that's why we've seen the crude prices moving higher over the course of the last week or so. It all really started back when the first time that the cuts were extended, that the market started to firm up in terms of the supply side constraints that caused. But we did see during the early times that demand was still in somewhat of flux because we were expecting a recession. China's economy was not growing, and they are all good events to destroy demand, and that kept the oil prices in check. Now that we've probably gone past the fact that the world's not likely to have a recession, and China is stimulating its economy ever so selectively, but it is growing. That's bringing perhaps demand for crude going back into China to the fore, and that's why we've seen the extra pressure on the oil price, and it's now heading towards $90 on the Brent side and a few dollars less than that on the WTI price.
Very interesting. Do you expect $100 to come by?
Look, we are expecting in the near term for Brent, the $90 is probably going to be the top. We do believe that if you have a look at the longer term play for OPEC and Russia, and especially OPEC, they don't want to have US production coming back on stream. If you can cast your mind back a few years when US production was at its height at about 13 million barrels a day, they were in fact the king price maker. And that left OPEC somewhat lamenting in their wake. Now that the whole scenario of pricing's changed, OPEC's now back in control, and in fact US shale production's lamenting, and we don't believe that they're going to want to increase the oil price significantly to see that shale production coming back on stream. So will $100 appear? If it does, we don't expect it to be there for very long. We do think that we will see, in fact, at that point in time, OPEC will actually start to reintroduce supply, and that will obviously pull the oil prices back. Their big enemy in the past has been that US shale production, and they really don't want to see it back in play. At $100, the marginal cost of US production is getting cheaper, because obviously there's been a very big turnaround on the downside in the industry and costs are coming out. So watch this space. $100, not likely. We're looking for that $90 where it roughly is now for Brent to stay for some few weeks.
I would ask you on the wild card here, which is the US hurricane season. That is number one. And the second is US again buying for its strategic petroleum reserve. Both the events, one basically is a continuous purchase, and second is the usual hurricane season. Is that something which you think perhaps can actually support the crude prices?
Look, certainly that would, if we see disruption coming out of the US in terms of hurricanes, yes, that would certainly support the oil price. And it would actually give perhaps OPEC some leeway to actually reintroduce production. So they'll be watching that very closely. In terms of the inventory drawdowns, that certainly is a sign that fuel inside the US is somewhat limited, and they've had to draw on those strategic reserves to actually keep gas flowing to the gas stations. So one would suspect that any disruptions from outside events to US production will cause that country significant pain at the pumps. So look, overall, we do think that OPEC, yes, they are controlling the prices at the moment. That's the space that they want to be in. They won't want to give that space up easily. So again, don't expect to see the oil price rushing towards $100, we think, anytime soon.
Very interesting. David, you always have some sort of interesting insights. I also wanted to ask you from a perspective, as per your own understanding about the cycles of crude oil, post December, does the demand start tapering down? Like when actually is the strength of the peak of the demand?
Look, usually for the US, we see demand rising during their summer holidays, which happens around their Independence Day. But you've got to remember now there's a very big country north of us called China, and we're still probably working through what particular seasons are incremental for their demand. One would expect summer or the Chinese New Year's when they're all going on I guess, extended vacations and leaves to family. But at this point in time, it really still is that US drive season that does tend to dominate what happens with crude prices. But we are now coming into their winter, and that will see somewhat of a switch away from oil to actually natural gas and heating oils as they go from driving their vehicles to having to heat their homes. So one would expect we will see perhaps some easing from that perspective seasonally, and some increases in natural gas prices and heating oil prices over the course of the next few months.
Let's now take a step away from crude and ask you what else you are liking in the commodity basket.
Well, I will say one of the commodities we are looking at, not everyone will agree with us on this one, is uranium. We have been now for a number of months looking at that in terms of buying up positions in producers and also in ETFs. The primary reason for that is if you have a look at the markets, we have seen a move in the uranium price, certainly over the last 6 months, to the high side after probably a decade of doing absolutely nothing. And the reason for that is if you have a look at the secondary market in uranium, i.e. the used uranium that comes from other sources other than mining, those sources are now starting to dwindle because the industry's had to call on those sources virtually for the last 10 years to cope with just moderate demand increases. Now that we're seeing global changes to climate and the demand for carbon-free energy sources, uranium and obviously nuclear power as its end play are starting to perhaps be taken more notice of, and that's why we're starting to get interested. It may only be a short-term play, but we certainly do think there is a window of opportunity there as we transition from coal, which has been the mainstay for a very long time to produce base electricity, to other sources to do the same thing. And uranium just looks as though it's got a nice niche at the moment to slot in and perhaps add value for some couple of years.
Well, interesting metal has many uses and also many interesting uses. But then apart from that, I can't let you go without actually asking you about gold. As you know, as Indians, we all fancy about gold. So let me ask you one question about gold. What's your view right now on gold?
Look, we've unfortunately had the US dollar direction wrong. We've been calling now for probably over 12 months for the US dollar to go down, primarily because we saw US debts rising. That certainly happened. And we believed that there would be a narrowing of the interest rate differentials to in favour of other currencies. That's the one part of the equation that hasn't happened. The US dollar, because the interest rates have remained in their favour, has remained high, and unfortunately that really has kept the gold price rallies in check. We did see it try to break towards the 2000 not that long ago. It couldn't sustain that, and of course it has drifted back down. So look, overall, we are still a bull on the gold price. I'm not sure that we'll ever not be, but we are being stymied because of what's happening with that US dollar. It's remaining stubbornly high. And until we see a change in direction in that dollar, we will see the gold price have difficulty in rallying beyond probably much where it is at the moment. And if it does, maybe towards 2000, but we need to see that US dollar go much lower. The metrics are there, except for those interest rate differentials. So it's just a patience game, we believe, for that to happen. Just on other matters, we've seen gold certainly been centre and front for central banks. They've been relatively big buyers, and that really hasn't pushed the gold price up. So we really are suggesting that get that US dollar direction right, and you'll get the direction of the gold price right as well.
Right. So that implies once the dollar starts correcting or falling, it implies the pending rally of the gold will start happening. So
Yes.
absolutely. And that brings us to the end of this show. And we are ending the show with sort of three summary points from our conversation. Number one, crude prices, perhaps the peak is already near the $90. Maybe some rally could be there, but that cannot last. So $90 is something where you're comfortable. Gold prices, we need correction in the dollar for the gold to rally. And uranium is something which you are really liking for the short term at present as an opportunity. So, Mr. David, as always, it's a pleasure. It was a pleasure having you on the show and getting all the insights on the commodities.
Thanks very much. It's certainly been a pleasure chatting.
And dear viewers, I hope you enjoyed this conversation on the commodities. For now, it's a wrap on this conversation.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.